The fund's performance in November was negatively affected by a pullback in precious metals and battery metals related equities following the nomination of Donald Trump as president-elect on November the 6th. The gold price entered the month around the $2,745 an ounce level and subsequently fell $200 an ounce, or 7%, over the week following the election results, as the dollar and treasury yields strengthened. Gold and silver equities had a much harder time, falling around 10 to 11% over the same time period. However, the gold price started recovering through the month as the US dollar pulled back ahead of the official comments by the US Federal Reserve on interest rate cuts and on rising tensions between Russia and Ukraine. In the gold market, the World Gold Council reported that China's central bank refrained from gold purchases for the sixth consecutive month in October, although overall central bank purchases remained very strong in Q3 of 2024, with 60 tons of net purchases in October alone, this being the highest amount recorded year to date. The net purchases were led by India, who added around 27 tons to their reserves, bringing their year-to-date purchases to 77 tons. This is a five-fold increase on the same period in 2023. Turkey added 17 tons and Poland 8 tons in October, bringing their total purchases this year to 72 tons and 69 tons, respectively. We believe that India and Turkey's motivation to increase gold purchases is a protection against currency devaluation, while Poland is likely stockpiling in order to safeguard holdings in the event of an escalation in the Russia-Ukraine conflict. But against these purchases, we saw speculative and investment demand for gold in the form of physical ETFs, as well as precious metals equities, really turned negative in November following the election results, as a number of positions were built up in the months leading to the elections on the basis of Kamala Harris winning the elections, and these were seemingly unwound in the 2 weeks after the election results. Base metals also came under a bit of pressure following the election results, as the stronger dollar translates to higher metal prices in non-dollar denominated regions, dampening demand. All eyes remain on China, though, where Chinese economic stimulus packages announced to date have failed to really restore confidence in a meaningful growth in demand for metals in the short to medium term. China's top leaders are currently meeting to discuss GDP targets and further stimulus measures. While any specific numbers settled on won't be revealed until the yearly parliamentary session in March 2025, market participants will scour the statements for clues of policymakers' conclusions. Now, critical metals actually got a boost this month, with China announcing outright ban on the export of several materials with high-tech and military applications, in a tit-for-tat move after US President Joe Biden's government escalated technological curves on Beijing. Gallium, germanium, antimony, and super hard materials like tungsten are no longer allowed to be shipped to America, according to China. Beijing will also place tighter controls on the sale of graphite. This came as the White House slapped fresh curbs on the sale of high bandwidth memory chips made by US and foreign companies to China, as the US intensified its campaign to contain Beijing's technological ambitions. China's response targets metals used in everything from semiconductors to satellites and night vision goggles. Two of the fund's largest holdings, Perpetua Resources, which holds a project in Idaho with a large antimony byproduct, sufficient for 25% of the US military needs, as well as Sovereign Metals, which is a very large rutile and graphite project undergoing a definitive feasibility study in Malawi, and which is 19.9% owned by Rio Tinto, received a much-needed boost on this news. Uncertainty with regards to what a second Trump term might mean for IRA funding and tax credits added another dent to investor confidence in battery metal sector. There's no doubt that the e-mobility transition narrative has been undisputably negative in recent years, which has led to the poor performance of EV and battery metal share prices indices compared to the wider industrial average. However, despite pervasive negative sentiment in the NEV space, sales remain strong this year, with global new electric vehicle sales having risen 24% year on year. This has largely been driven by China, where the growth has been 38% year on year, and a consequence of meteoric rise in Chinese NEV production has been simultaneous growth in the rest of the world sales, which is around 27% year on year, as Chinese OEMs seek export markets in an increasingly saturated domestic market. European BEVs could be about to become cheaper and more plentiful. Tighter 2025 emission standards have caused many OEMs to postpone the launch of mass market models until next year in order to guarantee that their fleet emissions come under the target. As a result, a slew of small BEVs priced under €25,000 are set to enter the European